Ah yes, the stock market, where you can buy great companies with your hard-earned money, prop your feet up, and then watch those companies go to work growing your money for you. Where you can watch dollar bills just flow into your brokerage account like water into a freshly unclogged septic tank. Where you can get, on average, an annualized return of 11% in a good S&P 500 index fund. The stock market is, as they say, one of the best places to build long-term wealth.
Oh my gosh.
Our stock portfolio is a dumpster fire.
Yep.
This is probably one of the most uncomfortable and embarrassing videos that we've made. It's easy to come out on YouTube and make a portfolio update video when things are going super well and you're like 20% in the green. It's not so easy to do that when things aren't going well. We don't feel like we are the only ones who are down this much, and so you're not alone. It's basically just what we want to say.
The second reason we wanted to make this video was to encourage those who want to pursue something bigger in their lives to go ahead and try and not wait until your life looks perfect.
Brit and I made the decision about a month and a half ago or so not to rely on a 9-to-5 income. So we quit our jobs and we're pursuing things that we want to pursue. If we were to wait until all of the obstacles that we see in our near future just kind of being removed for us to start that process, chances are we'd never take that first step.
Yeah, we would never take that leap of faith.
And the third reason we wanted to make this video is just realness. We just want to be real. We started this channel with being super transparent. We'll continue to be super transparent. Life's not perfect, and if all we do is just talk about the positive things going on and never talk about the negative things, that gives a super false impression of what life is really like.
So with all that being said, we're going to get into our 2 Roth IRAs, which we're going to combine together because they're pretty much similar. And then the second account is a brokerage account, and that's a taxable account. So we'll get into that as well.
So in our Roth IRAs, these all we have are just ETFs. If you're unfamiliar with what an ETF is, it's basically an index fund that you can trade throughout the day. So our first holding is VUG. Now this is Vanguard's growth ETF. So what this looks like is if you take the S&P 500 and you basically double the percentage weights of like the top 10 holdings in the S&P 500. So this is very tech heavy at the moment, but we have a little over 50 shares of this. We're down $3,721.57, which is about 25%.
Yep.
That hurts. All right. Our next holding is VOO. This is Vanguard's S&P 500 ETF. So another popular ETF that tracks the S&P 500 is called the SPY, the SPY. Bernie and I went with VOO here because it has a much lower expense ratio. I don't think the SPY's expense ratio is all that high, but Vanguard's is much lower. We're down, in these 9 shares, we're down $527.60, which is about 14%. Now we'll have more shares of VOO coming up here shortly. The next ETF we hold, we don't have much of this, is VTI, which is Vanguard's total stock market. So if you compare the S&P 500 to the total stock market, basically the S&P 500 has 500 stocks that it tracks, 500 companies. The total stock market has about 4,000, a little over 4,000, I think. So you get exposure to the entire market as a whole with VTI, whereas the S&P 500, you only get exposure to those top 500 companies by market cap. However, if you compare these on a chart, like they basically perform the same way, just because the top holdings are weighted very similarly. But anyways, with this one ETF here, we are down $66.44, which is about 19%. Okay, and the last thing is just more shares of VOO, the Vanguard S&P 500 ETF. We have 47 shares here. We are down $2,657.36, which is 13.64%. In total, in our Roth IRAs, we are down $6,972.97, which is a little over 18%.
So next we wanted to go over our brokerage account, and this has a lot of individual companies in it that you will see, and we wanted to invest in companies that we saw had a strong outlook for the long term and made products we basically thought would do well.
So these are companies we see a very high long-term growth potential for, or at least that was the intention behind this account, was just to invest in solid companies with solid profits, solid cash flows that made things, either products or services that people bought a lot of. That was the intention anyway.
Yeah, so let's get into it.
Okay, so first up here is Coinbase. Now, if you guys are following the cryptocurrency space, there is a lot of drama going on in that space right now.
A lot of uncertainty.
Yep. So we have 17 shares of Coinbase. Coinbase is we'll just say cryptocurrency brokerage. You can buy and sell cryptocurrencies on Coinbase. We have 17 shares of that. We're down $2,441.35, which is
74%.
Oh, a lot of cryptocurrency companies are going bankrupt right now.
Yep.
Voyager went bankrupt not too long ago. I think Celsius went bankrupt.
And now FTX is having trouble.
Yeah. Anyways, there's a bunch of drama and things going on in the cryptocurrency space that's very, very similar in my mind to the dot-com bubble in the early 2000s.
So basically, when all those new tech companies got their start, and then it was just survival of the fittest. That's what we feel like is going on right now for the crypto space.
Yeah. Okay, next up is Meta, formerly known as Facebook. We have one share of that. We actually sold out of most of our holdings of Meta. This is the only one that we were underwater for when we sold out, and we were so much underwater for it. We was like, oh, we'll just might as well hold it just to see
what
where
happens.
It goes.
Yeah.
We're down $262.38, which is about almost 71% in Meta. Next company we have is Nvidia. I love this company. Absolutely love it. They are a chip manufacturer. They make graphics cards and all sorts of things. People buy graphics cards to mine cryptocurrency, and with all this cryptocurrency drama happening like that, I think that's putting a little bit of downward pressure on this company. I think there was also something signed to where Nvidia could no longer sell their products in China that made the price of this company drop a lot. We're down $4,420.53. Or 40.79%. Okay, next up is Tesla. I love this company as well.
I love Tesla too.
But there's a lot of drama going on with Tesla too.
Yeah, there's so much going on with that right now.
We're down $9,955.41, which is 43.52%. This is the company we're down the most money on. So with Elon Musk buying Twitter, that put some downward pressure on the stock. With him selling a bunch of his shares to fund that acquisition, and then more recently, I think he was selling $3.5 billion worth of more Tesla, basically.
Yeah, it's just continued to put more
That's put downward pressure on the stock. There's a little bit of concern about their
production too.
Yeah, and
their production numbers went down a little bit.
Long term, I have high hopes for this company and Nvidia, but right now we're just kind of in the gutter with this one.
Yeah.
And the next up, this one hurts as well, guys.
Yeah, this one actually we knew going into, and if you looked at our past videos, that this was a risk.
Yep.
So we didn't invest, I guess, a whole lot of money at the time, but looking back on it,
more than we should have.
So we invested in Voyager.
Voyager Digital. VYGVQ, formerly VYGVF. So this is a company that's based in Canada. So you have to buy this stock over the counter. This is not listed on the NASDAQ or the S&P 500 or anything. Mm-hmm. Our cost basis is $11.14. We have 500 shares. We invested about $5,600 into this one. We are down 99.72%. We've lost basically all of our money because this company went bankrupt.
Yeah, it did.
They made a very unwise decision in lending out $600 million to another company that ended up going bankrupt.
They lent out a lot of their cash reserves to do this, and so when that other company went bankrupt, they had no cash.
There was some hope for Voyager in that FTX was going to buy it.
But now with the FTX drama, that's not happening.
So I was kind of hopeful that the stock price for this company may start going back up eventually with the FTX acquisition, but who knows what's going to happen at this point.
Yeah, it's a penny stock right now.
Yeah, but this was a great company. I mean, they were showing some serious growth. I don't think they would have gone bankrupt if they hadn't made this decision to lend out so much money, but unfortunately they did, and $5,600 down the drain. For us.
And our lesson learned too was to listen to our instincts to get out of it sooner. And when we had a profit, we should have just sold out because we knew it was a risky investment. Yeah. So lesson learned. Okay, and that's all we're invested in our brokerage account. We're down a total of $22,631.87 or 52.7%. So when you combine both of our Roth IRAs and our brokerage account, we're down a grand total of $29,604.84. Yep.
You just have to say that you're fine when you're not really fine.
On a positive note, though, that's not actually the total amount of money we're out. We did sell out of everything, all of our holdings, Roth IRAs, brokerage accounts, all of it, at the beginning of the year, and we took about $5,000 in profits doing that. We also didn't invest all of the money that we took out back into the market. We kept a lot of it in cash. Mm-hmm. And I did a little bit of day trading a few months ago for about 30 days or so, made about $3,000 to $4,000 in profits doing that. So in total, we're really down somewhere between like $20,000 and $21,000, which is less bad.
Less bad, but still bad.
Yeah.
So when we first started investing, we started at pretty much one of the best times to start, and that was in 2020 to 2021. And if we had stopped investing and sold everything at the end of 2021, we would have held on to a lot of money.
A lot of profits.
Yeah, lots of profits. We sold all of it and then reinvested some of those back into the market at probably one of the worst times when everything was going down.
Yeah.
In 2022.
So we've seen our portfolio be up a ton of money. We've also seen our portfolio be down a ton of money. So what have we learned through all this? Okay, let me preface this in that hindsight is always going to be 2020. It's super easy to give advice about the past once it's happened. But knowing now what we would have known then, obviously we wouldn't have bought back into the market when we did. We would have just kept everything in cash, especially given that Brittany and I do not have a reliable 9-to-5 income anymore. Like our only income right now is pretty much dividends, interest on cash that we have in our bank account, and YouTube income. That's it. So we would have sold out of everything much earlier. We would have taken profits. That would have given us much more of a runway to pursue what we're trying to pursue now, and a lot more financial peace about doing so.
And the next thing we would have done differently is not put so much money into individual companies in our portfolio.
Yeah. Not that we think this is a bad strategy, especially if you're researching everything you're buying into. But I think it's a bad strategy if you don't have time to keep up with everything you're investing in, which is eventually kind of what happened to Brittany and I over the course of the year. Voyager Digital being
a great
an
example,
example of that.
Yeah, we lost track of it, and if we had been researching it more, we would have probably saved ourselves thousands of dollars.
Yeah. All that being said, like, this journey has been a crazy eye-opening journey for Brittany and I. We have learned a ton about investing. I think our eyes have been open to a lot more that's going on than what we used to understand was going on. Before all this, like, of course, we had an academic understanding that, the market's not going to go up at an annualized 11% increase year over year. Like, there's going to be ups and downs. But on average, that's what it's going to return. At least historically, that's what's happened. Brittany and I now have the experiential knowledge that we could be up 25% in a year and then down 25% the next year.
Yeah.
Whereas before, we didn't have that experience. We didn't have that perspective. We've also experienced what I guess a little bit of what macroeconomic cycles look like. And so we're much more in tune with that than we used to be. We also recognize just the manipulative power the Fed and economic events can have on the stock market. So speaking of the market being down so much, if you are new to investing, this is actually a great time to get started.
I mean, the market's weird, but
the market's down like 20-30% so far this year. Maybe not that much with the market being up 7% today. There's been a lot of red. Like there's been a lot of blood in the water, and historically those times have been the best times to get in. So if you are interested in getting started investing in the stock market, Brittany and I have a Robinhood link in the description below. If you sign up using that link, you will get a little bit of free money to invest in a company of your choosing. I think they have a number of companies you can choose from. I don't remember what they are, but that'll give you a little bit of a head start. We also have some financial resources on our website linked below. If you're maybe just getting started in your personal finance journey, you can check those out if you want. We have a budget template. So with that being said, guys, thank you so much for watching. We appreciate it. If you enjoyed this video, please give it a huge thumbs up. It helps out tremendously.
And subscribe for more. You can follow us on Instagram at It's Mike and Brit. And we'll see you guys in the next video.
Yeah, bye.
Bye.